the key factor, if you're looking to buy or to sell in this marketplace, is understanding what your objectives are. Okay, if your objective is to just choke every penny that you possibly can out of the other guy, then it may be a perilous endeavor. Okay, if your objective is to put yourself in a better house with more opportunity to grow in time and to create happiness in your family unit, then that's another priority.
Sure.
And to me, that should be the priority that we're all looking for. I think that we've grown up in an environment where too many people look to crush the opponent and think in terms of negotiation is, I got to beat the other guy down to where they got nowhere to go. And if I've done that, then I've won. Actually...
All right, well, welcome back to the show. I've got my good friend, mentor, and the oracle of all things numbers in Acadiana and Louisiana, Mr. Bill Bacque.
Good to be.
Thank you, Bill, for being here. And I know we're already in February when we're shooting this. We're almost at the end of February, so we're late to the show because we both had some health issues in January and Mardi Gras, and then I caught the flu. So thank you for rescheduling with us and being here today.
It's always great to be here.
So this was going to be a recap for 2023 and all the numbers, but now we're in February, so we have January's numbers too. So we will talk about that a little bit. What an interesting, last 24 months, painful and exciting in the same time. I mean, we've got, our sales prices are still high. We've got low inventory that's driving that. We've got super high interest rates that have gone up and down just this so far this year in 2024, and we've got existing home sales down. We got new constructions that were up, and then now they're down in January. There's so many things happening right now. We could start almost anywhere, but why don't we jump right in and let's talk about 2023 sales.
Okay.
And I know one of your charts here, we did add the interest rates all the way at the end of this chart, of this presentation, but one of my favorite scattergrams and charts is this one because it has so much depth because you go all the way back into the 80s.
Right.
And I can't even get that data. This is data before the MLS was ever even in place because you've been keeping track of this. So this is something that
you got to be old.
You got to be experienced. So let's say that. And so tell us what you saw in 2023.
Well, as the graph kind of shows at the tail end of it, the last 3 to 4 years have been the contrast between a market that's moving or transitioning from the pre-COVID market to the post-COVID market. And it's not just the disease, it was all the things that were associated with the COVID outbreak that we had in 2019 and the government's significant pumping of $5 trillion of money supply increase into our economy and the Federal Reserve keeping interest rates at historic lows. All of that came together, and the shut-in of the entire working or most of the working population ultimately created an environment, as we all know now, that in 1920 and 1921 and all the way into 22, we had this pressure of significant demand. That was brought on by historically low interest rates, and that led to a enormous demand that exceeded supply and ultimately to higher prices. And that's what we found pre-COVID. Now, once the interest rates began to rise in 22, we started to see an adjustment down in 23, and actually in 24, we're hoping that the market has found its bottom And it seems like, looking at the early numbers, January closed sales, January under contracts, that in fact we are seeing a slight increase over last year as far as January and into February. Whether or not that's going to continue or not is predicated, I believe, on interest rates. One of the interesting things, and people talk an awful lot about, well, gee, we're current interest rates are 7.5%. Is that correct? You're more.
Yeah, we're just over 7.
So one might say, if you follow the national trend of interest rates going back to the beginning, the average interest rate, again, going back into the early 80s, is about 7.75% average.
Yep.
Now that takes into the account the early 80s, when there was 18% interest rates,
Right.
all the way up to today. The average is 7.74, 7.5%.
That's right.
So one would then say, well, gee, what's the real issue here in right now with interest rates? How is it impacting our real estate market when they're basically at the level they've historically been? And the answer to that is, it's all about the swing. It's all about the swing. It's about where we've come from to where we are and how quickly we have. And if you were to Google, or the audience were to Google, what is when was the lowest interest rate on a 30-year mortgage in the history in history? Okay. The answer that you would get back would be January 2021. Not 1930,
Right.
not 1960, not 1970, 2021, January. And that was when interest rates were at 2.65%. So what the shock to the system, if you will, as far as interest rates are concerned, is where they have come to, or where they've risen, how high they've risen from where they've risen to.
Yeah.
That is, we've gone from basically 2.65 to 7.5% in 2.5 years.
Right.
Okay. That's a shock to the system, and it is impacting people's decision to buy. When you
Right.
couple that with the increase in the average sales price that's occurred over the last 3.5 years, which is about $60,000 in average sales price increase from 2018 to 2022.
Yeah.
In 2018, the year prior to COVID, our average sales price in Keaty was just about $191,000. In 2022, December of 2022, it was $251,340. That's a $60,500 increase in that equity. So during the time that interest rates were rising to the level that they've gone, we also had a corresponding increase in the average sales price. And that has put a strain on the capability of buyers to be able to afford the product that's being offered in our marketplace. And that's our challenge.
And, we're going to get into it, but, that we're seeing that because that we're seeing more sales outside of the parish than inside the parish because the prices are less.
That's exactly correct.
And so that's driving more sales there. Now, the difference, which was really unique, we had just historic demand levels through the pandemic, through the first half of 2022. But at that same time, we were actually also having historic new listings coming. The demand was just eating it up so fast. So we had low inventory as a total number of inventory. There's a difference between new inventory and then the total inventory levels, which the total inventory levels is the ultimate supply available, which is why the prices went up. It wasn't because we weren't listing less homes during the pandemic. We actually were listing more homes, but the demand was so high, it was eating it all. And now it's created an environment that, which I know some of your charts will show that we've really never seen this low of inventory, since I've been in the business,
right.
This consistent. Now, when at this point, now we have less new listings hitting the market, but the ultimate, because demand is lower with the interest rates, we're actually seeing, that overall inventory level rise, which eventually, predicated on the interest rates, will determine, does that continue to go up? Or if interest rates go down, like some people are, either way, whether it goes down or up, that's either going to slow the new inventory from coming up or open it up.
Exactly. Yeah.
And that's
As a
going to
matter
be
of fact,
something
if
to
you
watch.
move this one more screen, that's new listings that are coming in. A couple of things that are kind of interesting. If you go back to the 80s, you'll see the highest year, singular year, that we had the greatest number of listings was back in 80, I think that's 84, where we had 7,874 listings. And it wasn't until 2018 where we exceeded that for the first time. So when we look back at the crash of the 80s, what was a primary driver there was the lack of economic viability in Lafayette or Acadiana. Basically, people were losing their jobs. We had tons of houses that were being taken back by lenders. People couldn't afford it. It was a high interest rate environment. So we had a flood of inventory that drove prices down. What we had in the last 3 years was exactly the opposite. Mm-hmm. We had demand that was driven so high by low interest rates that it ate up all of the increased listings that were coming on the market, even though we were back to levels, again, that we hadn't seen since the early 80s. Right. We had slowly grown to that level as our market had grown. But then we started seeing listings decline really over the last 2 years. Yeah. And the reason for that ultimately is as interest rates went up, those people who might have said, well, I'm going to take advantage of the equity that's growing in my house, and I'm going to take advantage of lower interest rates, and I'm going to move up into a higher, more inclusive home environment. And so you had a lot of that occurring as a result of that. As interest rates went up, it got to a point where many of the people who didn't sell refinanced. And so one of the points of data that's out there nationally is an estimate that somewhere around 75% of the homeowners, the current homeowners today, have refinanced their home over the last 3 to 4 years and are sitting on interest rates that are maybe 4% or less. Right. And that is the impediment to a seller making a decision when interest rates are 7.5%. Right. Do I want to trade in that 3.5% loan? Whether or not that's a valid decision to do it or not do it is something that a seller needs to make in consultation, in my view, with a real estate professional. Yeah. Because what you're going to be weighing in the future, my prediction, you're not going to see 2.5% interest rates again. Right. It's not going to happen. So what we're hoping will happen in 2024 is that we'll see interest rates somewhat stabilize in the 6.5% to maybe 7.5% range. Right. And then probably stay there for some period of time within that narrow margin. And if that ultimately happens, the longer there's stability in interest rates, even small gaps of inconsistency, but not the large swings, as long as we get into that kind of environment, people will adjust to that. Okay, and sellers will look at that equity and say, well, maybe I can use that equity to go ahead and move on up, but I know I'm not going to get, I'm not going to be looking at 2.5% interest rates. Now, it may be that it's going to take several years maybe to get that comfort, just like we have when you have flooding.
Yeah.
Again, the flooding in 2016 or whatever. The immediate reaction up to that in the marketplace was a reluctance in the marketplace. The longer that and that every house people looked at, did it flood, did it flood, did it flood?
The
longer
impact
you
of
wait,
that flooding event decreases over time.
it does.
It does. And we see that in
And
real
the
time.
swing in the interest rates will do the same thing.
Yeah.
If we
So
can
the
get
further
stability.
you get away from that anomaly, the less impact it's going to actually have on the perception of the market, which ultimately is going to, determine if somebody's going to make a move or not.
And that's somewhat proved out in January and preliminary indications in February that we're having a slight increase in the demand side.
Well, we also had lower, we started the year off with lower interest rates. Everything was looking really good. We thought that was going to continue.
The prognostications were that. So, yeah, some of what we're seeing in the marketplace is expectations can drive demand. But I think part of it also is that there's still a need.
Yeah.
You're still going, no matter what the economic conditions are, be it local or be it nationally, you're always going to have people who are forming families or families that are splitting apart. There are people that are passing away. All kinds of rationale for people being in the real estate market.
I'm glad you brought that up because I've got some stats here. But I remember in 2021 when we were doing our quarterly meeting and you were our guest speaker, you had mentioned, guys, like what's going to happen here? Because like I think you might even refer it to as like the golden handcuff, like. These people that are buying these houses at 3%, how are we ever going to, move up, right. Because we've got such a good low interest rate, our monthly payments to buy another house that is, more expensive for a family like our family is going to be a very challenging decision. And you're exactly right. That's exactly what we're seeing here, which is creating this pent up supply. Right. And pent up demand because of the lower interest rates that they're locked in at.
And it's also, because you can't control interest rate, those interest rates are set. Okay, what you can control to a certain degree is what I buy. What's my price point?
Yeah.
And so again, that's one of the impetuses for people moving outside of Lafayette Parish. I mean, if I go back in time when I was listing and selling real estate, we used to always talk about how affordable prices were, let's say, in Houston, Texas. But then when you looked at it and got down into the minutia, the fact is, but you might be living 50 miles away from where you work in Houston in order to get that price. Sure. But if you moved into the core of Houston, you were going to be paying some high prices for the real estate location. So Lafayette is a microcosm of that in the environment that we're in right now, and we've already kind of alluded to that. That people are looking outside of Lafayette Parish to find less expensive homes. That you can, on average, look at anywhere from a $30,000 to $40,000 difference in average sales price, whether you're going to be in Lafayette.
Even more when you're talking new construction.
Even more when you're talking new construction. You're right. So that is, and the other part of that is from a physical standpoint. Lafayette Parish is one of the smallest parishes in the state of Louisiana. So you don't have to go 50 miles to get lesser prices. You only have to go 10 to 15 miles from the south side of Lafayette, which is where most of the action is. So that's one of the things we're ultimately seeing in our marketplace, and that may have long-term implications in a number of arenas. One implication is as new construction moves outside more and more of Lafayette Parish and more sales occur outside of Lafayette Parish, you're moving a tax base that could be in Lafayette Parish out of Lafayette Parish, and long-term implications for the government and the coffers of the government of Lafayette, of the parish of Lafayette, are something that we got to consider. on the other side of that, we're seeing significant growth in areas like Maurice, where you have new construction subdivisions of significant size that are growing up over there, and that's going to have an impact into the future, not just new construction this year, but in the years to come. To have more and more of that population that is impacting on us, but from outside of Lafayette Parish.
And going back to what you were mentioning, the pent up supply and demand, because the further we get away from the lowest interest rates of all in history, the more likely people are going to move forward with making decisions. But they're still influenced by that interest rate. So, I think 7 and above, I think we're going to have a very slow rebound if we don't see interest rates come down, and that's going to impact demand, and it's also going to impact the supply. However, to talk about what you were mentioning, the 4 Ds, right? You've got diapers, diamonds. When people are still having babies, they're still getting married, they're still getting divorces, and they're still dying. The 4 Ds. Just in the next 2 years, this is according to NAR. There's going to be, in the next 2 years, 7 million newborn babies. There's going to be 3 million marriages. There's going to be 1.5 million divorces, that's unbelievable. 50% divorce. There's going to have 3 million marriages, and half of those are going to get divorced in the next 2 years. 7 million people are going to turn 65 years or older.
Youngsters.
4 million are going to die. 4 million are going to get new jobs. 50 million are going to switch jobs. So we obviously are still having all those things happen, and each one of those events usually triggers somebody to move.
Right.
And so eventually it's going to be released. Now the question is, and this is what we're watching, and this is what we're constantly looking at, does that supply get released? And interest rates, if they're high, then we're going to have an imbalance of supply and demand. Our inventory is going to skyrocket. Prices are going to come down. But if interest rates stay anywhere around 6 or into the 5s, we're predicting it's going to be a more of a balanced market. We're going to move more towards a balanced market, which is not a bad place to be. It's more of a back to normal. But we still have a long way to go to get back to normal when it comes to inventory in our market. Now, our demand is low, which is keeping those prices high, but going back to the interest rates is really going to determine that.
And as we said, what interest rates can be is not only a deterrent to a buyer, but a deterrent to a seller who's got a refinanced property and is looking at that increased cost to move up. And that sure bears out in the numbers that you see, that the 2023 new listings were 6,952. In 2022, there were 7,403, about a 6% decline. More importantly is we've seen the demand, the buying demand drop from 2023 to now we're at 2018. In 2023, we dropped back to about 2018 levels, back prior to the COVID breakout. Right. So that's kind of an indication that demand has settled to about pre-COVID. Okay,
that's right.
But new listings, and when you look at it last year, that's 6,952. It's at 2014 levels.
Right.
Okay, so we're 10 years behind in that new listings, and that's because I believe of the sellers that would be in the marketplace but aren't because of the interest rate.
It's a golden handcuff.
That's a golden handcuff.
They're stuck but
as time goes on, though, that hopefully those golden handcuffs become less tight. Let's put it that way.
Well, and it depends too, because let's talk about it. Like from a perspective, what does that mean to a seller? Well, if you time it right, and you grab that interest rate now, when we were in the pandemic, you came up with that famous saying is, marry the rate, date the house, and now it's flop. Now it's like marry the house, date the rate.
Right.
Well, a seller has a decision to make. If you look at our prices and the volume and the average sales price, you can see just compared to 2022 to 2023, it looks like we peaked in, and we are now could be potentially, depending on the inventory, on the way down. So as a seller, you've got a decision. Date a rate that you're expecting to go down in the next 24 months and refinance then. Get your equity out now, buy your house, because theoretically right now, the best time to get your equity out would be before it starts, to decrease.
Right.
What do you say
Well,
about that?
clearly we saw from 22 to 23 a decline in average sales price overall.
Not a huge one,
Not
but like
not a huge, only about 2%.
2%.
Okay.
Which we've had how much since 2020?
Well, in 2018, the average sales price was $190,800, and in 2022 was $251,340. That's a $60,500 increase in 3 years.
Yeah.
Okay.
So,
Never seen anything like that. So it's not
31%, 30% approximately.
not surprising that there's going to be some adjustment, especially when you look at what was the lower interest rate environment that we were enjoying. How did that contribute to rising average sales price? Well, it made the ability, as demand increased and supply constricted, it made the ability to raise prices a lot easier to do because interest rates were going down,
Yeah.
and your affordability made up for that difference. Now the roles have changed, and so either one of two things have got to happen. If interest rates don't drop, then we're going to see a certain percentage of buyers who are going to not be able to take advantage of the average sales price. And we see that by what we see buyers doing, and that is moving outside of Lafayette to look for more affordable prices.
I guess there could be that argument or somebody out there that's saying, well, as you know, if you live in Lafayette, there's not much inventory. So is it because of the lack of inventory, or is it because of the lack of demand that they're moving outside of Lafayette?
Oh, I think it's inventory. It's the cost of inventory. The reason to move outside, the primary reason is the cost.
But what I'm saying is, do you think the less sales inside of Lafayette is a demand issue, or is it because there's not enough supply? Because I know a lot of people right now, I mean, we have a list of people who are looking for $800,000 houses in Lafayette, and we cannot find them.
Well,
So if they had them, would that have increased the sales?
I get your point, and that's a theoretical discussion, but there's you could certainly agree there'll be some sales that are being lost because there's inventory that's not on the market, and that's contributing somewhat to it.
Sure.
I would argue because we are still seeing the level of demand that we have, which is, again, it's not as strong as it was 2 years ago, but it's still relatively strong. But where that demand is going is an indication that there's no question that cost has an impact.
Sure.
And interest rates have an impact. And just to give you an example, I did a quick amortization schedule on a $300,000 loan. Okay, if you were at 3% interest rate on a 30-year loan, and you were borrowing $300,000, your principal and interest payment would be $1,265. That's at 3%, not 2.5%.
Right.
Okay, at 6.5%, not 7.5%, that same $300,000 costs you $1,896 a month. The difference is about $630 a month.
Yeah.
Okay, so that's the impact of interest rates on a buyer. But more importantly, is if you only qualified for the $1,265, that is, at 3%, you could qualify for a $300,000 loan, but that was the top of your market because you qualify for no more than $1,265. Now at 6.5% to get $1,265, you'd have to borrow $200,000. It costs you $100,000 in buying power. Okay, so you can't say with this kind of impact that you have no impact.
Sure.
It is
and I'm not saying there's no impact. I'm just pointing out, and we're seeing it in January, that the increase in inventory that we're seeing, we're also seeing increases in sales. We saw that in January. So with the rise of even where we're at, with the rise of inventory, there's more houses, more selection, which is allowing more buyers to buy that otherwise wouldn't been able to, which is interesting because remember 2020, 21, we literally had buyers that tried to buy, couldn't get into the market because there was so much competition. So literally we had people say, you know what, we're too stressed out. I can't handle putting in multiple offers again. And we're just going to hold off, wait till inventory increases.
Right.
Unfortunately, the interest rates have gone up as well. So we're experiencing that. And but it's a there are buyers that are now coming back into the market as inventory increases because there's now selection, and there's still low selection at every price range in the core of Lafayette. That doesn't mean that every house that's out there should sell immediately, but as you know, the ones that are priced right, there's a very low supply of those houses, and the ones that are maybe sitting on the market for 6 months right now, they're probably overpriced or not managing their variables to make sure it's marketed properly.
And one aspect of the marketplace that we tend to overlook or under discuss because it generally is relatively small percentage, but there are a number of homeowners out there that have little to no debt on their home.
Right.
Okay. And so if I have no debt and I want to sell my property and buy another property, I could be involved in a transaction where interest rates mean absolutely nothing to me because I'm an all cash buyer. I'm an all cash seller.
Yeah.
We do have, and when we talk in terms of the older generation, people in my age, more and more of them may continue to fit into that scenario. So that part of the market too isn't impacted by these radical swings that we've had in interest rates.
Yeah, so Zillow did a study. According to Zillow, the fourth quarter of 2023, 21% of homeowners are contemplating selling their homes in the next 3 years, regardless of the interest rate.
Right.
So I guess it goes back to, it looks like the supply will be released eventually. The only question is the interest rates going to be lower or higher to eat up that supply, or are we in for another 1984 where we have huge supply and no demand?
Well, again, a lot of this is speculation of what's going to happen in our economic future. I don't personally, it's my opinion, that I don't see an opportunity again for us to have 2.65% interest rates for 30 years.
I think everybody agrees. There's no expert out there that assumes that we're going to see that again.
And so, again, I think a spread over the next 10, 15 years where we're at from 5.5 to 7%, if we could, operate in that interest rate environment. Heck, that's the interest rate environment we were operating in from 2012 all the way up to just prior to COVID. Interest rates were in that 4.5 to 5 to 6.5, 7%. We've seen that before. And so I think that's the environment we're going to be involved in. And I think what we're probably going to see is initially that demand shrinking back from the 2021 high to 2018 levels, and that we'll grow from there maybe at our traditional 3%, 3.5% growth.
Yep.
Okay, in numbers of transactions. I think that's more realistic.
Which, by the way, if you took our average growth over the last 30 years, and we still are higher than we probably should be by a lot. I mean, with a 30% growth in the last 36 months in sales price or whatnot, I mean, we should be, I think, somewhere around the 250, 260 average price range. So if we were to average it out over the next decade, we still have some room to come down
I
on
agree
the
with
average
that.
price. But it's all dependent on when is that supply going to be released. So as a seller, assuming you have a mortgage, like, what does this mean to you? What would you be thinking about right now if you're in one of these categories that you're going to be moving in the next 36 months? Do you put it up for sale today or do you wait?
Well, I think the decision reflection point for that, or the reflection point for that decision, is getting closer and closer to meaning that, hey, when it was 2.5%, I could easily answer that question.
Sure.
Go out and borrow all the money you can
Right.
at 2.5%, because you ain't never going to see that again. Okay.
Right.
That's an easy slam dunk decision. Now it's getting to be more about, what are your needs?
Yeah.
Okay. What drives you traditionally to look for a bigger house, a different house, different area? Could be job, could be, again, marriage, could be any number of things. Could be need for more square footage. Even some of the post-COVID effects, where we have more and more people that are now in job environments that allow them to work out of their homes. And so you need more room for offices. All those things occur. And you have the challenge of affordability for people who are wanting to be first-time owners. That's going to be the real challenge moving forward. Again, keeping in mind, back in the 1980s, when we had 16, 17, 18% interest rates, the average sales price was like $55,000.
Right.
Okay. So everything's relative there. Now, the average sales price, just compared to what it was 3 years ago, is $60,000 difference. And so I think that's the challenge for us looking forward, is what kind of housing are we going to be able to provide for the next generations that are coming up, so that the American dream of home ownership isn't something that is a myth, and it's a real dream. And I think that I'm hearing more and more of the younger generation coming up that has a perception, based upon the craziness that we've been involved in market-wise over the last 3 years, that there is no future home ownership for them, that they're destined forever to be renters. And if that's ultimately the attitude that we come out of this with, then we'll all be losers as a result of that. But I think we need to think in terms of more density, smaller square footages, more affordable duplexes and triplexes where you live in one unit, rent the others. Those types of ideas need to be more embraced by our governing entities, as opposed to restricting growth, in order to ensure that we have the proper type of housing and housing affordability for the generations to come in the future.
I agree with you, and and going back to the average sales price, so like from a seller's perspective, and I want to hit two different sectors here in a second. I want to talk about investment properties and also just residential sales. So I mean, it looks like, and correct me if I'm wrong, we're not going to see another 30% increase in values in the next 3 to 5 years. It looks like we're moving back to where we typically are, which is about 3%.
I would agree with you.
So knowing that, if you're a seller and you just experienced 30% increase since 2020, shouldn't it be on your mind, like maybe I need to take this equity to power my move, even if interest rates are higher, then possibly not see that again for another 10 years.
It's certainly something they need to take into consideration. It should be part of their decision process. And a lot of it is going to be, what's the size of that equity?
That's right.
Relative to the differential that you will see on the borrowed side. Because if you have a significant amount of equity, maybe what you're going to borrow is going to be less,
right,
as far as principal is concerned. It may end up be slightly higher payment because of the interest rate differential. You have to look at your individual circumstances. And so when I give talks to civic clubs or things like that, and we talk in terms of the data, I always say, caution, this is what the data says overall. How that applies to you individually, you need to get away from the guru of numbers, me, the guy who looks at it from 5,000 feet, and you need to call a real estate professional like a Jim Keaty and have him come to the curb, your curb, and say, let's look at your home in this environment that we have. This is what you're looking at, parameters you're looking at. Now let's look at what your needs are and see how the market fits your needs there, and how we can mesh those two economically. Can that happen and it be a positive? The answer is absolutely yes. Will that be the case for you, every single individual owner? No, it won't. You need to have a real estate professional advising you there.
Well, I mean, you hit the nail on the head. I mean, and full disclosure, this is the data for everything, but it's not the data for your neighborhood. Every neighborhood is different. Every price range has different inventory levels. And I'm seeing it even now. Like, you can go into an area where there's oversupply, and you can go in areas where there's lower supply. And until you really dive in and know what that market is, what's going on, and because every neighborhood is a little micro market.
Absolutely. Absolutely.
But what's interesting is, okay, so we know that we're not in for, it doesn't look like we're going to see interest rates go down to anywhere near where they were, to drive up the demand to unbelievable levels. But, we just talked about a residential sale. Do you cash in that 30%? One thing that's been interesting conversation with some of the people I've been having with my investors is, wait a second. Typically I want to keep my investments for a very long time, and I might have a good interest rate right now, but do I cash out and get that 30%? Because I'm seeing, like, if you bought a property in 2018, 19, or before, you potentially could be sitting on an unbelievable amount of equity right now in an investment property that makes it worth selling, and then going out and maybe buying something, or even just keeping the money until something comes up, buying something bigger, an apartment building or more. And so that's an interesting dynamic, because up until, a few months ago, I've always been, some of the worst decisions I made was selling a house. Now, I do believe that they're going to continue to go up in the long run, but do you cash out now? Take that 30% that you just made in 3 years and then flip it to something else.
Well, fortunately or unfortunately, we're not born with foresight. Okay, that is, we don't know what the future is. What I do know from investing, and what I've learned from both the bad and the good, is if you have a profit, you invest in something, and it returns a decent profit to you, and you take advantage of that profit, that is the life cycle of an investment. An investment is not just the acquisition and the cash flow.
Right.
You want to do the whole life cycle of what's the internal rate of return on an investment. It involves eventually a getting rid of it, disposition of it. So what would I tell somebody who wants to take advantage of a 30% or 60% or $60,000 profit, is that if you have some need or some place to put that then why not take a profit?
Sure.
I mean, you don't own forever. You can't own forever because we're not going to be here forever.
Well, it's interesting you said that because, like, I would say even more so in the residential, there's less inventory even in the commercial. I mean, investments.
Right.
Like, I mean, there's still high demand for investment properties. More demand than it's been consistent. That really hasn't gone away even with the higher interest rates, which is surprising to me. And there's less supply than I've seen, pretty much since I've been in real estate, which is half the time you've been in the real estate business. So like it's very interesting, and that dynamic goes into the rental market, which you would theoretically think higher interest rates would be more demand in a rental. And in the last, I don't know, 2-3 years, we've seen such a high increase in rentals and sales. And just in the last, I don't know, I would say since August of last year, we really had, less demand for even the rental market. And we went through a really slow period. If you talk to a lot of the property managers out there, they would say it was really, really slow. Now we're getting into that seasonal time period where rentals are even picking up and the people wanting rentals are picking up. But what is going on?
Well, part of that slowness that occurred over the last couple of years may well have been as a result of the abnormally low interest rates that you could get, so
Right.
that the cost of rental versus the cost of home ownership was pretty close. And given the choice between can I buy, if I can buy, and if my total outlay monthly is anywhere close to what my rental outlay is, I'm going to probably opt for ownership because there's an upside potential over time. Average person today now owns a home for 13 years. I can almost guarantee you, if you go back in our chart, you go back 13 years, you're not going to see the line going down. You're going to see the line going up.
Right.
And so for long-term investments, home ownership not only is a good investment, but it also provides you all the other things that homes do.
And
now,
simultaneously, we saw an increase in rent.
but
So
we
maybe
did.
we hit that level, that top level of the rent.
We did, and part of that that attraction to investing in real estate came as a result of during the low interest rate COVID years. Remember, you didn't have that happen in a vacuum. If you had money, cash, you weren't getting anything for it. Yet in the bank, you almost had to pay the bank to hold your money. So if you had liquidity, it wasn't paying off anything, and there was a search for where am I going to put my money to where I can get some kind of return on my investment. A lot of that turned to real estate and said, let me get that, especially with the cost of debt being as low as it is.
We saw rent increase, so that was good. And now that ate up all the supply.
Right.
And now we have no supply. Prices are still rising for investment properties.
Right.
Rent has kind of hit a plateau, but
that's going to be one of the things that's going to be hamper the idea of an expanding inventory. Yeah. Although, we are seeing an expansion of inventory that has occurred simply because the demand is going down. Because, again, we've had the drop in the demand. If your supply just stays the same, it doesn't have to increase, but if the supply stays the same and the demand decreases, you're going to ultimately get an increase in supply. And when we look at the number of months supply of product, we see that certainly has occurred in our marketplace. And
yeah, we're seeing the months of supply, the whole overall months of supply in residential home sales increasing. The question is does the interest rates go up or down, which will impact the demand, which will ultimately determine whether we have more sales, less sales, higher price, lower price?
Well, I think, again, like we both said, if we can keep the interest rates increase in interest rates within that parameter that we talked about, 7.25 to, let's say, 5.5%. If we can keep it in that range, I think we're going to be fine.
Well, I'll tell you, like right now, I mean, and you know the numbers, it's healthy. There's people out there, even where we are currently, and it seems like we have a good pipeline of demand right now, like just from our sales and our pendings. You know, even at 7%, I'm actually a little surprised of how busy our market, our agents and our team have been in January and February. And now it's interesting to see, like, if they go down, it could be a even more release of demand, which could potentially hurt our supply. But, you know,
Well, in January, we had an increase in demand over last January of about 6.5%. That's sales, not under contract. Under contracts were even greater. But our active inventory increased to 1,795 active listings. This was as of January 31st. There were 1,384 in January of last year. So that's about almost a 30% increase in the number of active listings on the market versus last year. Last year, there was a 2.6 month supply of product as of the end of January. This year, 5.5 month supply, which is right at equilibrium. This is for all of Acadiana.
That was December.
This was in December, it was 4.5.
4.5.
In January, it was 5.5.
January 5.5. Yeah, we're definitely moving back towards
we're getting
a balance.
A more balance. It depends on the price point as to what that number can be. But overall,
But overall, the number of new listings is well below where we were in 2019.
you're right.
Like the total number of sales, we're still far off.
We
from
are.
the total sales, almost by a third?
Yeah.
Yeah. I mean, that's a lot.
Yeah.
You know, but the demand is less, so that's keeping the prices up. But I will tell you, just from our sales meeting, our morning huddles, you know, our leads coming in, we have buyers, and you know, it's not a flood, but I mean, it's a healthy amount even at where we're at. So I'm just a little surprised with interest rate. I'm surprised interest rates went back up, and I'm surprised that, you know, the demand is still there. So some of my agents are like, hell, you know, keep everything where it is right now, because I've got a book of business and I've got a pipeline, and other agents aren't working because they think it's terrible.
Right.
You know. So, I mean,
Well, I've looked at your company's numbers first couple of months of this year versus last year, and you've increased significantly, at least in January.
January,
Yeah.
it's you know, I think there's a part of that is, you know, one of the pillars of business that we've been working on, and this makes complete sense, is some of the new construction builders are offering super low interest rates. They're buying it down. So now that purchasing power, instead of being, you know, $80,000 away, now they're able to buy, you know, 40, 50,000 more purchasing power than if they were to buy an existing home.
And I would venture to say, and it's not going to be true in all cases, but in many cases, as you have inventory that stays on the market, your ability to negotiate more favorable terms increases as a buyer. Just as you see builders buying down interest rates. Right. Well, that's just another way of lowering the price, because right. It's a cost to the builder to buy down that interest rate. That this gives you more negotiating capability. And that's another positive ultimately for people who are considering buying. It's not just that, I wish I'd have bought 3 years ago. Well, you can wish all you want. You didn't do it. And now if you want a house, this is not a bad time, because interest rates are not 18%. They're right. 7.5%. And, you know, we'll see where they're going to be. But if they do drop substantially after you buy, you can always refinance.
That's right.
During your home ownership. But what you are going to be able to see increasingly is more and more flexibility on the part of sellers in their negotiability of
100%. We are absolutely seeing that. Like, some builders who, would never, ever negotiate at all are coming to the table. They may not be dropping the price, but they might be buying down the rate.
Right.
It may be, hey, you want us to repaint it to a different color, or hey, we'll add certain. They're trying to keep the prices where they want to be because they got 10 other houses to sell.
Right.
But we are seeing more flexibility in the back end, which means, it's not always just about the price. There's a lot to buying the property and getting the right deal and making sure it just fits. Like you said before, like, what is your plans? What do you need it to be at? And in a lot of cases, we can do that. I mean, Mr. Bill, it's kind of unheard of. Like, I would say probably about 6 buyers in the last 2 months, we've put in new houses with a rural development loan, 4.99% interest, and literally they're coming to the table with nothing. They're buying a $230,000, $250,000 brand new construction outside of Lafayette Parish, and they're getting a 4.99%. They're getting rural development, so 100% financing, and they're leaving with their deposit.
Wow.
And they're getting into a house. So that's driving a lot of those new construction numbers too.
Absolutely.
Because now, where that might cost me $20,000 as an existing home seller to buy it down that much, it's just not, it's not as available. So that's definitely something that's been interesting, and you're seeing it in the numbers with the new construction, which, we're talking about new construction. Lawrence Lund, the economist for the Realtor Association, nationally, last year, 2023, was the best year we've ever seen for new construction. They had a 33% increase in over 2022. Now, we didn't see that here in Lafayette. I'm just wondering, why do you think nationally that was such a big number, but locally we didn't see
Well,
that?
I think part of that is the lack of inventory of existing homeowners that, for whatever reason, decided they weren't going to put their property into the inventory pool. And so there was a lack of inventory nationally. And the only way you can fill that gap is with new construction. Now, why do we not see it here in Lafayette Parish? Well, we did see this. We did see new construction in Lafayette Parish perform better than existing home sales.
That's right.
On the demand side. The other thing that we are seeing is that when we look at what's happening outside of Lafayette Parish in new construction, and I pointed that out in my presentation that, in 2023, there were, this is 21, page 21, there were 422 reported new construction sales outside of Lafayette Parish, okay? In 2022, there were 289. 21?
I'm on the wrong page. Let's see. It doesn't match up.
Doesn't match up. Oh, then go back. What's going on outside Lafayette Parish? It's going to be back. There you go. Okay. So again, in 2023, there were 422 new construction sales outside of Lafayette Parish. In 2022, there were 289. So we had a 46% increase outside of Lafayette. Now, in 2023, there were 893 Lafayette Parish new construction sales reported. In 2022, there were 1,056. That's a decrease of 15.4. But the decrease in the amount of existing home sales in 23 in Lafayette Parish was 27%.
Right.
Okay. They declined 15.4. Now, when you look at all of them together, the 1,315 total Acadiana new construction sales, the 422 that were outside of Lafayette comprised 32% in 2020, excuse me, probably 32.1. In 2023, 22, excuse me, it was 21.5. So we increased percentage-wise. You asked why that didn't happen here, and well, it did in new construction if you take into consideration all of Acadiana.
Right.
Okay, and but what's happening in new construction is there is an exodus from Lafayette Parish by builders to be able to put the product down that can hit an affordability factor. And the next page basically shows you where that building is and what the average sales price is for new construction. So for Million Parish, for example, the average sales price new construction is $244. In January of this year, average sales price in Lafayette for new construction, $327,716.
So what do you think? So that makes a lot of sense because it's just more expensive in Lafayette.
It's just more expensive.
It's more expensive. So the buyers are buying at a higher rate outside of the parish. But from a builder's perspective, what does this data mean to you? Like what would you, if I was if I'm in the building sector and I've got to build more houses to keep my family fed, how would you decipher this information?
One of the things I would look for is if you were going to build, it depends on the price point. Okay, so if you're going to build, let's say in the 260 to 270 range, you're going to have, or 260 to say 299 range. You're going to have a limited amount of options in Lafayette Parish. Number one, lot options or whatever. So again, I might not look at Lafayette Parish if I'm in that price point. If I'm doing the 300 and up, there's still a market in Lafayette. As a matter of fact, in January, we had 23 new construction sales in Lafayette Parish above 300,000 that closed. Last January of 23, there were 10. Right. So there's a 130% increase. Yeah. So there is still a market in Lafayette for upper end houses. There was one new construction sale in January over $1 million in Lafayette Parish. So are there still, is there still a market?
What's the supply like though in the upper price range?
In the upper price range from 300 and above, but overall 7.1 months.
So you would think, from the overall picture of the higher end, there's more supply than demand, but they're still selling.
They're still selling.
So it means you really have to be competitive with the product you put out there.
And in certain price points, for example, new construction 350 to 399, there's a 3.9 month supply product in new construction. So it depends on your price point. You need to look at what your competition is. You need to look at, if you're a builder, you need to look at how competitive you can be with regional builders that are out there that typically build in that more dense price range, and they do it competitively because of their large footprint they may have in a region or a state or even nationally. So it's a competitive. You just need to look and see what price points. And the difficulty for a builder is I make a decision today that I'm going to put down a spec home. Well, that home doesn't show up for another 5 months or so, 4 months, 4 to 5 months. So I'm making determinations based on data, supply and demand data today for a piece of product that may not come on the market for another 4 to 5 months. And I have no idea how many of my cohorts are having the same or making the same decision at the same time I am. So there's only 3 houses on the market when I make the decision to build this particular property.
Sure.
But then all of a sudden, 4 months from now, I have 9 properties on the market.
Right.
So what's the matter? Well, everybody, you're not exclusive as far as ownership of data.
Yeah.
So the same stuff that makes you want to move to make a decision may in fact be making your competition do the same thing.
Well, we're also seeing, the existing home sales in Lafayette Parish. We know there's a shortage of higher end price range houses. I know just from the demand that we have right now, there are people out there looking for, anywhere between $600,000 and $1 million, just over $1 million. That just doesn't exist. And when that right house comes up, they'll buy it. But it's the conversations that we're having right now, people are starting to think maybe we should just build.
I would, again, looking at the number of months supply in end of January, 600 to 699, 4.3 months supply. There are 13 active listings. There were 3 sales. In the 700, 799, 17 properties on the market, 3 sales, 5.7 month supply. So both of those are, and actually going all the way up to the 900 mark, you have a 5.6 month supply of product. So that just, you're absolutely right. In upper end, there is still some.
But most of the month of supply there, I would argue, if they've been on the market for 6 months or more, they're overpriced.
Likely are.
You see what I'm saying? So it's saying
the people who are shopping in this have seen these houses and they're waiting on the new one to come on the market to see if it meets.
So my point is it looks like there's more supply than there actually is, because if you have the right house, you price it right, you position it right, you're going to sell it, maybe within a week or two, and you could potentially even have multiple offers.
What I would argue, and again, it doesn't mean that there's not a potential buyer waiting out there for your house. If you're in the $1 million or over, at least at the end of January, there were 26 active listings. Mm-hmm. Okay, there's 2 sales that have occurred.
Yeah,
that's a 13-month supply product. A little crowded there when you got 26 active listings. You have a 7-month supply product in the 300 to 350 range. Again, this is existing homes. 48 active listings out there. So there are price points where you're going to have competition.
That's right.
And one would presume that, yes, as you pointed out, of these, let's say 48, 300 to 350 homes, $1,000 homes, of them, many of them are shop worn, but those sellers are also probably very willing to negotiate, or more willing to negotiate. So again, it depends on the price points as to whether or not, and you need to look at those. And for example, I'll pick out another one in the 190, the 200 to 220 range. There's only a 1.8 month supply of product of existing homes. You need to be with a real estate professional who has the data, has the information to be able to take you along as a buyer or as a seller and say, if you're going to price yourself in this price group where it's going to be quite competitive because you have this many listings. But if you price yourself here, you're competing against less.
It's an interesting spot to be from a practitioner standpoint, because we've seen the prices rise to what looks like the peak, and we're still pushing the envelope in some cases. If you are positioning the property correctly, you're still able to sell, and we are doing it every day, a house at the top of the market ever in a neighborhood, right? So there's still outliers here, but you've got to be realistic. And I think a lot of times when we're talking to sellers is having that strategy. Okay, here's what the data is telling us. I understand you want to push it as much as possible. If you're going to do that, then you have to do everything. We do it right. You got to have it staged. You got to have the videos, the everything. And then from that perspective, you got to have a strategy to come down if you're not going to hit that. If your goal is to move it within, the next 60 days, get it under contract, you can't just leave it there and hope that, cross your fingers, it's going to get there. You got to do everything you possibly can, and you could still possibly sell your house more per square foot than any other house in history in your neighborhood, but it's going to require a strategy and find exactly where that is.
Well, yeah, that gets back to what we already talked about. The key factor, if you're looking to buy or to sell in this marketplace, is understanding what your objectives are. Okay, if your objective is to just choke every penny that you possibly can out of the other guy, then it may be a perilous endeavor. Okay, if your objective is to put yourself in a better house with more opportunity to grow in time and to create happiness in your family unit, then that's another priority.
Sure.
And to me, that should be the priority that we're all looking for. I think that we've grown up in an environment where too many people look to crush the opponent and think in terms of negotiation is, I got to beat the other guy down to where they got nowhere to go. And if I've done that, then I've won. Actually, one of my first mentors in real estate taught me this when he sold me a piece of property, and he created a cash flow for me on this property that he said, you're going to need to pay me this so that you can get this. And I told him, I said, you should be able to get more. Why are you selling it to me for this? And he said, what I'm selling it for is none of your business and what's motivating me. But I'll give you this little bit of advice. I was 23 years old. He was probably 70 years old. He said, if you can make a deal where somebody walks away feeling like they've won and you can walk away feeling like you won, then that's the deal you want to make. That's the best deal. Not the one where I took the most money I could get or I got the best, most solid deal I could get. It is one where both people walk away and feel like they won. You've just done a transaction where, in fact, everybody wins. And there ain't nothing wrong with that.
No, that's a great advice for sure. It's interesting that you mentioned it should be about, moving you forward, your family, happiness. And sometimes some people get caught up with having to actually net money. And, I said, listen, because we get questions just like you do, should I do this remodel in my house? My first question is usually like, well, do you want it for yourself? I mean, are you doing it to sell it? Or are you doing it because you want to do it? We're thinking about doing it. We'd like a better kitchen and, just want to make sure I'm not losing money. Well, it's funny that people have that conversation when they go out and buy a car. And at the end of the day, that car is worth nothing.
Right.
But we're talking about your house. Like if you're going to be there for more than 5 years, enjoy it. You're doing a remodel right now.
Doing a major remodel.
Like, enjoy it. I'm sure you're not doing it for the hopes of making more money later one day when you sell it.
Oh, no, I'm not.
So, I mean, same thing with pools. Like, hey, should we put in a pool? Hey, do you want a pool?
Yeah.
Put it in. Like, enjoy it. How many memories are you going to have in the pool?
Right.
And don't worry about whether or not you're going to make it all back or not, because, who cares if you enjoy life and have a good time?
Right.
That's really what home ownership is really about.
Amen.
Now, we've gone probably way over our time, but before we go, I want to talk a few more things because we're already in February. How's 2024 doing so far?
Well, we've still got another day's worth of closed sales tomorrow in February. Yeah. But I expect we were a little bit ahead in closed sales in January. February, I believe we'll probably be somewhere around that 6 to 7 to maybe 8% ahead in closed sales. Right now we're just below, but the last day you get an uptick in closed sales. So I still believe what we're doing and what we're seeing. And if you go back into December, November, and October of last year, that takes these 5 months, and you've not seen a lot of this. What you've seen is like this. So the idea of what we were looking for is a market that's establishing its bottom or stability. I think you can argue it looks at this point, at least with 2 months into 2024, that we may be in fact establishing that bottom around the 2018 levels that we experienced back then.
And we'll see that in the next 3 months, whether or not that's the bottom.
Yeah.
Whether or not we see it, and that's going to be all predicated on the interest rates.
Well, and again, if you follow what the financial gurus are saying, that the Fed is making indications that they will likely not address interest rates until June, if they address them at all at that point. So, where we were expecting the Fed to act in March and start beginning to reduce their Fed rate, now people are wondering, is it going to happen in June or not? So I'm not sure what's going to happen relative to interest rates. I don't expect them to go up significantly, but whether or not that downward trajectory is going to happen by mid-year or by third quarter is going to ultimately depend on whether or not the market reacts in a very positive way. I think right now it's just a holding pattern.
But from January, we definitely had an increase in sales. I think it was 6%.
Yes.
Increase.
Yes.
And then we had a 17% increase in pendings.
Right. Although those are adjusted downward as deals fall through.
Sure.
But still, we're way ahead.
January,
Right.
like, what do you think it's going to end up being, like 10% pendings, which means February should be somewhere around 8-10% more than February last year.
It certainly could be.
And then our dollar volume was actually higher.
A little bit higher.
And pending 8% higher,
Right.
which is, we saw that on the chart that you had there. Like we dipped down from 2022, but we could see that
We could.
increase all depended on that interest rate. But like we started the year off lower.
A lot of that depends on who was buying,
Right.
who was buying in those first 2 months. So again, I like to get a little bit more data. The first quarter's data gives us a little bit of indication. By mid-year, we should have pretty solid idea of what track we're on. By the third quarter, we ought to know pretty much how the year is going to shape up.
And we saw a 13% increase in the supply in January, so we could potentially see.
I think that'll continue to happen.
Yeah. So if that goes up, depending on whether that's coming. We know there's pent up supply.
There's more.
It was a desert last year.
Right.
I mean, literally, there was no new supply coming on the market.
Again, hard to make that qualified decision relative to rates and moving into giving up my rate and moving in and taking advantage of my equity. Now, as we see the prices starting to dip a little bit, that's going to be more incentive for the seller to say, well, maybe I need to maximize my equity position.
Back to that conversation there.
That's exactly
Do
right.
I need to take advantage of it now, or
got to call a Keaty agent.
Yep, that's right. Please. So that it's going to be interesting to see what happens with this. This is the mortgage rate.
That's the swing.
That's the swing. Now, right now, okay, the Fed, if they don't do anything with the 10-year Treasury yield, we could still see interest rates go down depending on how the market feels, because we've got typically it's 1.7 spread over the last 30 years whenever they started doing it from the 10-year Treasury yield, but right now we're at 3.
Right.
So we still have a lot of room to see, hey, what's the risk factor for these banks, and and how that's going to
Yeah.
to shift.
And the other part of that is, that terrible word. What's going to happen with inflation? It appears that it is on the downward track that the Fed wants. They just want more validity. That is going to be something that's sticky. And assuming that's the case, if we can get the Fed to start loosening money by the end of this year, I think we're all going to be in good shape.
So, a year ago, you and I were doing this, and we were talking about inflation and the interest rates rising, and maybe even it was end of 2022, but you had said, the Fed's either going to rip it off like a Band-Aid, or they could drag this out over the next decade. What do you think so far? How have they been doing?
Well,
where do you think we're at?
I mean, we can't argue with. As I said before, to be blessed with foresight is something we could all wish for, but we don't have it. I think hindsight, looking at what they did, they made a mistake in the early days by considering inflation to be what they call transitory, and therefore that they did nothing, and they waited, they waited too long. And now we realize it wasn't transitory, it was entrenched, and it was getting worse. And now the battle it took longer to ultimately get to where we are. So I think they made mistakes. I think that's what's holding them off from making the mistake of loosening too quickly. I think that everybody who has any kind of economic background understands that when you put $5 trillion of new money into an economy, it is going to cause some chaos, and it's going to take some time to ultimately absorb that excess amount of money supply to get us back to normal. And that's why my thinking is long term, we're probably going to see long term interest rates in the 6 to 7.5% range, 5.5 to 6 to 7.5% range, probably could go out for a decade, because it may take that long to ultimately absorb that money. And we got a Congress that is adding $1 trillion to that each year. And so long term, how we can get nominal low interest rates for a significant period of time, again, relative to this area in here, I just can't see it. I don't see it.
Well, and if you look at the history, and I don't have the chart here, but you've got, at 7%, it's weak demand, 6% is good, average demand, and then anywhere in the 5s is strong demand. 2 and 3 is just insane demand.
It's amazing. Again, I bought my first house in Lafayette in 1990, 89, 90, around that time. No, maybe 85. No, 88, 89. I had a 13.5% adjustable interest rate. Cool. Okay, all day long. I can do it all day long. Okay, back then that was fun. Yeah. I love my house. Okay, so it's all relative.
Sure.
It's just all relative. What's shocked the marketplace is where we've come from in so long a period or short a period of time. That when we look at swings, and I've got that swing chart that shows the interest rates back in the 80s. Right. It's kind of interesting. I think it might have passed.
Did I pass it?
Keep going. There. Is that it? The swing? Yeah. So you can see in the decade from 71 to 79, interest rates went from 7 below to 7.23 to 12.90. The median was 8.8. The swing, I can't see it from here, was 78%. Okay, look here. Now we're doing not 10 years. These are all 10 years. Okay.
Yeah.
This is 2020 to the present. Low 2.65, high 7.79, 194% swing. We've never had this happen to us before. People don't understand that. You know, oh, we had 18% interest rate. I'm not interested in that. I'm interested in what was the dynamic of that in terms of it happening. We've not seen anything like we've been through. And so it's going to take a little disruption, but we'll get back on track. We'll get back on track. One thing that I do want to touch on too, that's another factor, and you have more information on this than I do because I'm retired, and that is, what's the impact of the availability and cost of insurance in the overall scheme of
That's
things?
interesting too. I mean, I would say in the last 6 months, we've lost more transactions because of insurance than I've ever have in the last 10 years. Okay. You know, I mean, you're talking, because what it's affecting the purchasing power of the client, which is, we may get all the way close to closing and then find out, oh man, we can't afford the insurance.
Right.
So we're changing our strategy, which is we're dealing with that way ahead of time. Even when we're listing the house, we're dealing with the insurance quotes prior to going under contract, because we can't lose that time.
Well, that was the point I was going to try to hope that you would make, is that what is happening in the insurance world is now forcing us to look at insurance in a different light as part of the home sale transaction. Whereas for years and years and years, when I was in the business, the insurance was the last thing you did.
That's right.
You're getting ready to close tomorrow, well, go get your insurance, okay?
Right.
And it was an afterthought,
That's
okay?
right.
Now it is a before thought.
That's correct.
Okay, because the cost, and the other part is just the availability of it.
Yeah.
Can I insure the asset? If you can't insure it, you can't sell it.
Yeah. I mean, and one of the interesting thing is like our insurance experts, they're saying, hey, if the roof is older than 5 years, we get a problem. That's insane. Like you could have a 30-year roof.
Oh yeah.
That's 5 years in, and we're having a conversation about how do we get insurance for it.
It's crazy.
So it's interesting. I think that's a whole nother conversation, but that's not going to change for us. There's nothing that Baton Rouge is going to be able to do to affect that really consistently. I mean, it's just going to be part of. That might be why the new construction is doing so much better as well, because the insurance is less because it's got new everything. But one of the things that I do think in the long term is a solution is the fortified roofing program. I think in the long term, if we can get our houses to that standard, which all it is it's basically taping all of the seams so that if you lose your shingles, the water doesn't come into your house and ruin your house, which ultimately, if you can do that, then it's going to lower the cost, 20, 30 years from now. But we've got so much work to do. But that's one thing that, you can do to affect the overall claims, because, where most of the claims happen is if you lose shingles, it's not replacing the roof, it's replacing your kitchen, your sheetrock, everything else. So if we can figure a way to delay the water from intrusion coming in, if there is a storm, then there's a lot less being claimed.
Right. I get you.
So hopefully that happens and continues to happen. And I know Jean-Paul and them, they're meeting and they're trying to attract insurance carriers to come in, and they're throwing money at them. But it's going to be interesting.
It's going to, again, like we talked about at the beginning of this session, it's about the timeline. That is, when you had the flood, the impact of that is immediate and effective for the next 2, 3, 4 years, the further you get away from it. So if we have, let's say, another 3, 4 years where we have no hurricanes, no claims, and we have an environment like that, then maybe the insurers will get more and more open about.
I guess in general, what we're doing is anyone who's got a roof that's older, we're bringing our roofers over there to see if there's any storm damage, and seeing if we can help that seller make that claim. But ultimately, that can take 6 months.
Right.
So we're building it into the price. Like, hey, like we're doing a roof right now today on a house that's closing on Thursday, but it's subject to the new roof. But we're working with roofers to do the roof prior to closing and get paid.
Out of the closing.
Yeah. So we're just having to get a lot more, up front, get all this lined up. Of course, we don't do the roof until we have final loan commitment, but we've got some good people that can do it, and they can also help the homeowner sometimes make a claim, even though they don't know there was a hailstorm 6 months ago.
It's interesting because a lot of times people don't understand, what does a realtor do to enhance a transaction, to help me get where I want to go. And it's not just, hey, I'm going to list it, I'm going to put a sign in your yard, I'm putting it in MLS, and we'll see what happens. Yeah. This is an example of what a competent real estate professional can do to facilitate a real estate transaction. We get into all the nooks and crannies, and insurance is one of them. Here's one. In order for you to be able to help your clients consummate a transaction, you're having your construction people involved, or you're having roofing construction people involved in replacing a roof.
That's right.
And negotiating their payment out of the proceeds of the sale. That is something that is a value enhancer that you get as a service from a competent real estate professional.
No, you're right. And I'm just grateful to have team members that can see this sort of stuff, and a lot of it is coming from mentors like you, learning how and what is going to kill a deal to try to save it. I mean, this. One of our good friends, Adam Andrews, we were talking about this over a drink the other night, that how many deals would fall apart if the buyers and sellers were handling.
We're negotiating it.
It is because a lot of it is just managing different personalities and making sure that we keep the goal in mind, which is to have somewhat of a win-win. Like, hey, let's move you to where you need to be and put you where you need to go.
The example I always would use is that you have two people on different sides of a transaction, and they're looking at it each from their perspective. And the key for us is to be able to be above each one of them and look at it from the perspective of, I'm looking at it this way, you're looking at it just this way. I'm looking down and saying, I can see the big picture.
Right.
Okay. That's the idea of, we want a good deal for everybody. When everybody walks away happy, okay,
and that's the importance
of
having a good title attorney, a good insurance company. You've got to have all those pieces.
All the pieces
and
have
working
to be
together. And nowadays, communicating all together is becoming, paramount.
Amen. Amen.
But Mr. Bill, thank you so much again. I hope that you continue to do this. I know that you've talked about retiring, but we're expecting.
Kate has been nudging me. You're going to do this.
This can't be our last one, and there's other topics that we should tackle.
Absolutely.
Together too. So.
Well, when I had my COVID and I was locked in the house, even though I'd said I'm not doing these anymore, I did January. It's just like, I got to do something. So I don't know how much I can get away from the numbers. So
I knew that was going to be the case. I've talked to some other people who said, he's getting out of business. He's not getting out of the business. You love this too much. You're obviously passionate about it. You're adding so much value to our whole industry, especially here in Louisiana. So hope that I get you next quarter.
You got it.
All right. Thanks, Mr. Bill.
All right.